CME Group is launching Micro E-mini futures contracts. Discover how a smaller Micro E-mini futures contract opens the world to greater trading possibilities.
Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Thanks for having me, Jeff.
While the stock market rally persists in the face of some uncertainty, one of the markets has your attention this week, Bob.
Yeah, I like that you called it uncertainty. We're talking about the optimism in a U.S.-China trade deal, positive Fed policy now, but we don't know what this deal is going to look like. We don't know what the details are, and we don't even have one yet.
It is interesting, that implementation of that trade deal. We're also knocking on earnings seasons. Right, this Friday, we're going to see the banks come out. What are your thoughts on earnings season?
Yeah, the banks are always what's going to charge the earnings market in one direct, or the earnings season in one direction or the other. So very focused on some of the bigger banks.
All right, it's time to get this first lightning round. Are you ready?
I am ready.
Crude cruises higher. Well, kudos to you, Bob. You hit the nail on the head. I know your price target was at $65 when we were still stuck in that $55 to $58 range. So now that crude oil is elevated up here, what are your thoughts?
Well, we've been looking at that $65 range since the beginning of March. It's been a congestion area. We broke out of it. That's where that target came from.
Well, that's interesting. So now, is there a reason to potentially look at the downside here, or is this move going to continue higher up to $70? There
absolutely is a reason. Bull markets in crude oil go sideways, up, sideways, up. So I'm buying the week 3 61 put for $210, and I'm selling the 59 week 3 April put for $80. This trade example is buying of a put spread, and it costs an investor about $130. This $2 put spread expires week 3 in April.
Very interesting. So you're trying to mitigate risk to the downside. And remember, folks, this May futures contract was trading around 63.77 when this trade example was priced, and the at-the-money volatility was 22.95. So the break-even point, correct me if I'm wrong, Bob, the break-even point for this trade example is $60.87.
That's correct, and it allows an investor, if they were long, to potentially stay long using this put spread to mitigate the downside.
Great stuff, Bob. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
Let's do it.
Trade deal time. Well, we have been talking about this trade deal for quite some time, Bob. Where are we right now this week in Q2 on this trade deal?
We're awfully close. China's been positive about it, which matters to me because when they want it done, it's likely to get done because they'll concede more. But overall, I think we might be a little high for not having seen a deal.
Well, it's interesting you bring up a little high. We have seen a couple 100-point move higher in the E-mini S&P 500 off of the optimism on this potential trade deal. So what I want to approach the market with, my trade example, is selling a risk reversal. We talk a lot about a risk reversal, but all this is selling an E-mini S&P 500 call and buying the E-mini S&P 500 put. So I want to approach my trade example by selling the E-mini $29.50 end of the month. That's the end of April call. I'm going to collect about $240, but I'm also going to be buying the $27.50 end of the month put for a little under $300. Net, Bob, this is going to cost about $60 to put on this risk mitigation approach.
Yeah, I love this example, especially with at-the-money volatility is about 10.56 when we looked at that. Break even about 27.4885.
That's right, and we're seeing this trade expire on April 30th. In June was the E-mini futures underlying contract. So, Bob, as we kind of put a bow on this box here, a lot going on this week in the markets. Earnings season potentially could move us a little bit one way or the other in the equities, correct?
U.S.-China trade deal, Fed policy, earnings, and then we move on to U.S.-Europe trade deal.
Well, Bob, thanks as always, and thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.